morning and welcome to our latest virtual roundtable brought to you by Bridging Commercial and kindly sponsored by Together. Thank you very much for joining us today. My name is Beth Fisher, editor at Medianett, the publisher of online titles Bridging Commercial and Development Finance Today and the bi-monthly print Bridging Commercial magazine. Today, we will be looking at how asset acquisition and loan purpose trends are changing in the current environment as we move into a post-COVID era. The multiple lockdowns we have all endured has prompted many to reevaluate their living situations, whether on or off the property ladder. The search for more space, flexible living, closer proximity to parks and green spaces, and access to a garden have and continue to be on the checklist. To help with this evolution, last year, the most radical reforms to the planning system since the Second World War were announced by the government with an aim to make it simpler to build better homes where people want to live. This means greater freedom for buildings and land within town centres to change use without planning permission, in addition to a wider range of commercial buildings being allowed to change to residential use. It is integral that despite a reduction in planning red tape, these future homes provide better support of people's health and well-being than traditional housing estates, which can be achieved if all parties look at deals through an environmental, social and corporate governance lens. Consequently, the high street will change. We've seen numerous retailers and department stores disappear in response to the pandemic restrictions, and also a structural shift in working and shopping patterns. A report by Elliott referenced the weaknesses of the high street model, its fragmented ownership, low rents and high vacancy rates, to actually become strengths as they lower the barriers to entry for new concepts and operators, leading to a more diverse environment in our towns. It will be interesting to hear from our panel today what trends they're seeing from their clients in terms of asset acquisition and also in town centres and suburban areas, and how they expect the high street to reinvent itself. In addition to how the approach to investment is changing, so are borrower profiles. We hope today's discussion will explain how brokers and lenders are keeping up with and tailoring to borrowers' increasingly complex needs, what's in store when the stamp duty holiday comes to an end, and also the gaps we're seeing for existing and emerging loan purposes. Joining me are a fantastic group of experts in the specialist finance market, and now is the perfect time for me to hand this over to our panelists, who will each spend around 2 minutes introducing themselves. I'd love to start with Tanya, please.
Hello, I'm Tanya Elmaz. I'm working at Together. I've been with Together for 6 years. I've been in the specialist lending market for approximately 20 years. I lead the sales team in the south, so there's 4 individuals that cover from Birmingham to Cornwall, and our specialism is all loans really, because we cover the regulated and unregulated side of the business, so that's short-term loans and long-term loans as well.
Thanks, Tanya. Lorenzo?
Thank you, Beth. My name is Lorenzo Satchell. I work for Together. I'm in the specialist market now for my sins for over 25 years. I've been with Together now for over 10 years, and I cover the London region for the business.
Brilliant. Nick?
Hi, Nicholas Christofi, Managing Director of Sirius Property Finance. We've been around now for circa 5 years, born out of the Brightstar Financial Group. We do everything from structured finance to specialist buy-to-let, to recently setting up a care and hospitality business as well. We have about 15 specialist brokers with us, and mainly deal in the B2C space. Thank you.
Thanks for that, Nick. Miranda?
Hi, everyone. So we have our technology business, which essentially helps brokers source their specialist finance requirements now online. So currently we have 180 lenders on our platform, and it predominantly focuses on business funding, property development finance, commercial loans, both long-term and short-term. And we've got a collective experience of about 40 years within the business. So hopefully able to bring a bit of advice in some of the specialist areas.
Thanks, Miranda. Paul?
Yeah, morning. My name's Paul Elliott. I'm Managing Director of Propp. We're a specialist mortgage intermediary, primarily focused at the moment on bridging, specialist buy-to-let, just moving into the development space. We're direct to consumer rather than B2B. And the business has been running now for about 18 months. November last year, we launched Propp website, which is a comparison website for customers looking for bridging finance in a non-regulated space, commercial mortgages, and as I say, recently launched development finance. I've been in the industry for about 20 years. I've specialised in this sector of the market since about 2012. Yeah, and interested to find out other people's views on where the market is and what's going on at the moment.
Thanks, Paul. And Chris?
Yeah, thanks, Beth. I'm Chris Oatway, owner and director of LDNfinance. We have a team of 30, which covers everything from residential mortgages, buy-to-lets, and specialist finance, including bridging, development, and commercial. We're based in the city, and yeah, been going for just 4 years now. So yeah, looking forward to the chat. Thanks to Together for the invite as well.
Brilliant, thank you. Just as a reminder for all of our attendees today, you can submit your questions in the throughout the panel discussion. There is a toolbar on the right of your screen where you can ask your questions in the chat box, and so please do feel free to ask questions to any of our panelists. I will be checking those throughout the discussion, and we will save the last 5 to 10 minutes of the hour today to go through any of those. So I'd like to kind of kick off this discussion with a question about where we're seeing requirement for funding. So Lorenzo, as we start to come out the other side of all of this, what areas and sectors are you seeing the biggest requirement for specialist funding, and how does this compare to the pre-COVID situation?
Thank you, Beth. I think, first of all, from a lender's perspective, if we look at our pre-COVID levels, we had a steady flow of transactions across all of our product range, whether that be reg or unregulated transactions. Probably could highlight 3 or 4 areas really where there's been a demand and requirement during the pandemic and now coming out of the pandemic really. So I think first of all, if we look at holiday lets, specifically in UK hotspots, there's been a massive demand there. That's been a big opportunity for us as a business, bearing in mind that we do first-time buyers, first-time landlords, no minimum requirements, and we can look at restricted properties as well. I think that will continue to be a hotspot anyway, and a demand there for holiday lets going forward, despite the holiday restrictions, because I think holiday makers are going to be erring on the side of cautions for travel, and I think staycations are going to be very popular going forward. Undoubtedly, also other areas that we're looking at as well. If you look at the high street landscape, that's changed dramatically coming out of lockdown. We've seen a lot of the major high street retailers disappear, which means fewer acquisitions for traditional shops. But what it has brought to light is purchases of sort of semi-commercial properties. For example, if there's cafes with flats above, so there's certain certainty for the client that there's a residential element involved there. So we're doing a lot of commercial term business there. I believe there's been a resurgence of the rental market, where landlords are looking for bridging facilities to refurbish their properties, and maybe put more rooms in their properties as well, so they can get better yield for their portfolios. And I think last but certainly not least, if you look at a lot of the developers now, they're snapping up commercial opportunities to change of use to resi. So that's where I think sort of the main demand is at the moment.
Thanks, Lorenzo. Nick, what inquiries are you seeing at the moment in terms of different kind of sectors that differ from pre-COVID?
I think, well, we were doing a hell of a lot of permitted development before the pandemic. I think what the pandemic has shown us is the requirement for outdoor space. So we've seen from a lender's perspective now that there has been permitted development is a fantastic model in terms of acquiring, being able to convert into a multi-unit block. But we saw during the pandemic that selling those units without the outdoor space was going to be quite restricted. So there's two things that we've seen a lot now is that a lot of refinancing, whereas before maybe at the end of a development scheme for permitted development we would put on a dev exit facility. Now we're having to make sure that we've got a term facility lined up for them as well, because the sales just aren't there on the PD schemes. From that, we're seeing that lenders have got a huge appetite now to lend on housing schemes with outdoor space, and can really be quite punchy with regards to how good their terms are for that type of stock, to lend on that type of stock anyway. And I think the other thing we saw, that as soon as the pandemic hit, that the two main sectors that got smashed to bits were care and hospitality. So we as a business made a conscious decision to really try and strengthen our area, our part of the business, by bringing in some specialists in that space. So, and we're seeing that there's a hell of a lot of opportunity now in terms of advice, people requiring the advice in the care and hospitality industry.
Do you feel that there are more lenders in that area now, as you've obviously created this new division?
I think that I think there are some that have always specialised in those sectors, and I think that there are some that listen, I think we're in a position now where we've never seen as much money in the market, for whatever the reason being is. Even though we've gone through a pandemic, I've never seen so much liquidity in this space in my life. And what we're going to be seeing is a lot of lenders that aren't getting maybe that much money out of the door, because listen, if we're being perfectly honest, there's probably too many lenders in the market, if we're being perfectly honest. But I think if they want to now start going and getting some market share, they're going to have to look at other asset classes which they never necessarily got involved in before. But if they want to go and get money out the door, then they're going to have to start looking at those different spaces.
Miranda, what have you been seeing in terms of inquiries?
So I think from our perspective, we saw at the start of the pandemic, you know, people that potentially had commercial properties, either on an owner-occupied basis or an investment basis, struggling to come out of maybe shorter-term debt facilities, predominantly because they either would have commercial tenants that weren't paying during the pandemic, and also owner-occupied businesses that were suffering quite considerably because of the market circumstances. They weren't able to be open, therefore, you know, that's taken a massive impact onto both their turnover and everything else. So we're seeing a lot of refinancing of those opportunities coming through now. A lot more lenders willing to look at owner-occupied commercial term facilities, which is great news, and probably an area where previously that have been quite underserved, but still caution with a view to, you know, having to go into another lockdown, I think is probably making lenders slightly more cautious. So in some areas, I think there's still a gap in that market, in that funding market. Again, very similar to what Lorenzo was saying, we have seen a huge number of holiday lets with people that potentially have never ventured into that space at all, really interested in sort of buying holiday units and in particular locations, which is quite interesting. And I think from a developer point of view, people making sure that they will qualify for the Help to Buy scheme. So from a unit size, altering maybe unit sizes and, you know, the size of those properties to ensure that they're qualifying at the end of the development.
With the new investors that are entering the holiday let space, if they're a first-time holiday let owner, do you feel that there's enough finance solutions for them?
I think there is certainly more coming up as time goes by. There's no doubt about that. I think it's a very different market to what people think. So I think staycation, I do agree with Nick, is going to be a very large and sort of increasing business. I still have this feeling that, you know, as we live in a post-pandemic world, people will still want to get on a plane and ensure that they get a couple of weeks of sunshine. So
Lorenzo, how are you seeing loan purposes change at the moment, and where are the gaps for these?
Well, I don't necessarily see gaps as such. I think from our perspective, I think loan purposes, I mean, bridging still remains strong. If you look at pre-COVID transactions, a lot of bridging was for purchase acquisitions and refurbishment. I think what's changed now is the transaction type, where you're seeing certainly the first quarter of this year, you've seen about 20% of transactions have been for chain breaks for completing on purchases on properties. So there's definitely been a shift in changing that pattern. We're seeing a lot more developers, as I mentioned before, acquiring commercial assets for change of use, because obviously relaxation in the planning laws. So ultimately that's going to change what the high street looks like going forward. And I think, but in the short term, I think what we've seen, and due to the sort of stamp duty deadline, is a lot of purchases, home movers and buy-to-let investors. We've had to change with those demands as well. We've got a new set of buy-to-let products that are coming out at the end of the week. So watch this space. I can't tell you too much about it now. But that's really where we've seen those changes. I think Nick might have touched on this earlier as well about people's changing work patterns. I think people are now buying out in the suburbs. We're seeing a lot more of that. So consequently to that, people are financing for home improvements, extensions, conversions, outbuilding conversions. So that's where we see a lot of change in loan purposes.
Do you think that will continue? Because I know some people have said that it's a bit of a knee-jerk reaction to the pandemic. Do you think that will continue?
I think only time's going to tell on that, Beth. You know, I don't want to be sort of trying to sort of predict the future here, but if you speak to some people, they want to get back into a work in an office environment. If you speak to other people, they're saying, my work-life balance now has never been better than ever. You know, I'm more productive, and you know, working from home works for me. For me personally, it doesn't work for me as a general rule. You need to be in an office environment, but I suppose it's down to personal opinion at the end of the day.
I think, Beth, just on that, obviously our office is right in the heart of the city, and a lot of the big corporates have already given up office space. And we're talking about businesses that employ 4,000 people in their offices in London have just given them up completely. So I mean, if you go into the West End, yes, it's still that's getting busier. The city in general is an absolute ghost town still. So I'm not convinced that it's ever going to get back to how it was. I think businesses have learned that it was going that way anyway in terms of a modern way of working, and having the flexible working life. And I think that the pandemic has probably just accelerated that. But I can't actually see it getting back to how it was for a long time. I think businesses have been able to streamline. They've been able to work having smaller teams now and having people on furlough. It's probably made them more profitable. Take the rent out of that and the rates that they're probably having to pay in these city locations, it wouldn't surprise me if they started taking back smaller space and just doing a hot desk model. It seems to be that's the way a lot of these industries are going at the moment. And like I said, we're up here every single day, and it is literally like a ghost town.
Thanks for that, Nick. Chris, would you agree? And are you seeing loan purpose trends change?
Yeah, I mean, we're down the road from Nick, so we've seen it gradually get busier, but there is not much. There's not been a huge change. I'm not sure about the West End. I mean, I'm sure at times it looks a little bit busier, but certainly in the evenings, everything seems to be quite quiet. And I think 3 days a week is the norm now. Everyone's set up to work from home. Everyone likes having that Friday at home. Friday seems to be a day that no one is in the city. It's absolutely dead on a Friday. You know, the start of the week certainly seems to be a bit busier, but you know, even if people have got all that outside space, they might be an hour and a half away now. But if they're coming in 2 days a week, staying in a hotel one night, then they're happy. They can go back and then they can carry on, see their family, juggle their work-life balance in the way that they want. I think everything's changed now. I don't think it's ever going to go back the way it was. But I don't necessarily think that's a bad thing. You know, if people are happier and businesses can make their everything work in that way and still manage to manage their teams and you know, expand in the way that they want to, whether that is a requirement to hot desk on certain things or get bigger office or more space just to keep everyone happy when they are in the office. However it works, I think everyone has adapted already and they will continue to adapt moving forward. And it's forced technology to move for to improve. But I mean, coming back to the sectors that people have pretty much covered off, we've noticed a couple of things that have changed over the last year or so, where, you know, student accommodation deals were coming in thick and fast at one point, and they were you know, really easy to fund in the right locations with the right level of occupancy. Now lenders are very cautious because they're not sure what's happening with the new term starting in September. I think we're going to be pleasantly surprised, and we've now seen developers trying to target this market because it's one of the only sectors where really we're seeing strong profits and not an over demand to be able to acquire. Yes, they are harder to fund, but there are better opportunities with certain margins if that developer is willing to take that risk in a sector which at the moment is an unknown. And this could be either an investment purpose or a development. The other thing is obviously all the online retailers that are out there, that all the demand has gone to them, as opposed to the high street, which was on the way out anyway. And you're now having to build these absolutely huge storage centres outside of city centres when you've got vast amounts of space. And we're talking, you know, 90,000 million cubic meters of space on these things. These things are huge to deal with the level of demand. And the sector, although yes, we have almost too many lenders, if we could have the same amount of lenders, but then people targeting in sectors where others aren't in, that would do us all a favor, rather than try to crowd the same space where everyone's trying to dip in and just try to you know, hammer on those rates to try to secure the business. So if people can sort of learn about lenders should learn about certain sectors that they may not be in now and try to secure business where it's underserved, then I think they're going to do a lot better than trying to do the same thing that other people have been doing for a long time and doing it very well, because it's hard to move away from people that you know and trust. Certainly now, as we all know, you want to rely on that lender to get the deal across the line.
Yeah, I agree, and I think we're going to see that kind of diversification of the niches where lenders sit in kind of happen, evolve in that way, just because lenders can't keep competing on rates, for example, just because it's not sustainable. You mentioned a bit earlier about the both you and Nick, about the reduced footfall in city centres. Is this impacting lenders' appetites for, you know, borrowers who are looking to invest either in cities or in kind of local towns?
I think it certainly depends on what the asset is. I'm not sure how much demand there is for offices, but it depends on who's coming in. If someone takes a nice long lease and they're a very strong business, then it's going to be a fundable transaction. in other sectors, it might be very different. If you're setting up a new commercial business or a restaurant or a bar or anything along these sectors, should I say, it's going to struggle, and you're not going to be able to have real evidence of how you're going to turn that business around or how to launch it over the next year or so. Time will tell, but yeah, without a doubt, lenders are looking at locations like the city as a very specific location where it needs to be underwritten in a certain way to understand whether it is a suitable one to lend on, and if so, what loan to value do they feel comfortable and what's the risk they're taking. But certainly, I think in the same way that when Nick was mentioning PD schemes, that has a certain risk on its own right now, unless they've managed to build in a little bit of outside space for every unit, whether it's a little balcony, a little bit outside the unit on the ground floor. Everyone wants that little bit of space. So everything is changing, and the city's changing, and all around it. Move out of central London, and things are pretty normal and quite exciting, actually. These housing schemes are absolutely booming. And previously, where some lenders might only want to be lending to £800 a square foot, or up to a 1 million unit value, they're now happy to go much higher, because that's where the demand is. People are moving out to have a nice big house, a nice big garden, and they don't need to be into the office within an hour. They're happy to be that much further out, and that's been exciting just to see the movement itself. I mean, even just today, the number of delivery vans or moving vans outside all around where I live in southwest London, it is crazy. Obviously, the stamp duty is just the stamp duty holiday has created this massive surge, and I think I heard someone saying the other day that in the last week, JMW themselves, as a solicitor, had 600 completions to do within 1 week, which shows how crazy this is going to be over the next couple of days.
Yeah, it's definitely interesting, and especially I think one of you mentioned the kind of trend where people are working from home on a Friday now, and that is normally the peak time for Londoners to be on the streets of pubs and piling out of those kind of venues on a Friday after work. So it will be quite interesting to see how investment strategies change, especially that sort of investment, and if more borrowers are looking at pub acquisitions or hospitality acquisitions in local town centres where people are now at home and they've moved into those suburban areas. So that will be really interesting to watch as that pans out. Tanya, in addition to the changing asset acquisition strategies, how are borrower profiles changing, and are lenders and brokers keeping up with tailoring to these more complex circumstances?
I think borrower profiles have drastically changed, actually, and they're still changing. It's sort of an evolving feast, and that's right back to things like credit profiles, where people have had missed payments, and that might be missed payments for sort of lack of income, or it might be missed payment for unstable self-employed type of income at the moment. So that's going to really affect borrower profiles. I think in general, the way people work, we've covered it off already, but the way people work is massively different, but that can sort of filter down to the way people are paid. So you might have gone from a full-time job to 2 part-time jobs, or you might go to contract work, or you might have been made redundant or change roles. So there's lots of changes in the way that people are working and the way that they're paid, and that obviously impacts their borrowing ability. I think we've changed our spending habits. I know I have a little bit, getting back to normal actually now, but in the last sort of 9 months or so, I think spending habits have really changed. I think that people might be needing to work longer. You might have had a plan to retire at 65 2 years ago, and that might have changed now because something, your lifestyle, your working conditions may be different. So I think all those types of things put together really do impact the borrower's borrowing ability, and I'm not sure if the high street is the best answer for those types of changing needs, but I think the specialist market is definitely up for all those types of different borrowers, because those type of borrowers are going to need bespoke solutions. It's not just the black and white situation or computer says no. And fortunately, together we cover all those types of scenarios where people have changed roles or changed the way they're paid or only been self-employed for a year or things of that nature, which is really, really complex. So I think it's not over. We've seen borrowers' profiles really change over the last year, a little bit longer actually. And I think we're going to continue to see that because we're not out of the furlough scheme, we're not out of C-bills and other government-backed loans are still coming to an end. So we've got further evolution of borrowers' profiles. And I think lenders need to continue to be flexible, agile, take on board what is going on around them, and that's by communication with brokers. I'll give you an example. 18 months ago, Together didn't have a furlough criteria, nor did anybody. I don't know about you guys, but I had to look up the word furlough when I first heard it. I thought it was an American term. But lenders quickly got criteria for furlough, and Together, and I'm sure other lenders, that criteria has changed as the rules for furlough have changed as well. So lenders should be and are able to be agile to make those sort of changes. And I think brokers just need to make sure that they're aware of all the options that are out there, and they're aware of all the specialists, the depth and breadth of specialist lenders and what they can actually provide, so that the clients have got the right solution, that no client is turned away for a complex or new type of situation.
Paul, through the Propp platform, are you seeing more lenders kind of tailor and amend their criteria to keep up with these new requirements from borrowers?
Not as much as we would like. I mean, going back to Chris's point, I think that's something that lenders need to learn from is to not to sort of drive to the bottom in terms of margin, and actually find niches that they feel comfortable with and that are underserved at the moment. So I think there's a lot of work that lenders can be doing to prepare for some of the changes that I think we're going to see over the next 12 to 18 months. You know, touching on the changing profile of clients. Tanya pointed out there something that we've all got to take into consideration is that we're still not out of the furlough scheme. There's a lot of companies that have got CBILS loans that they've got to start addressing in the next 12 to 18 months. Even before the pandemic hit, we were at a level of unsecured credit commitments that we hadn't seen pre-2008, and that's still there. And it wouldn't surprise me if that bubble is really, really getting to a state where it's going to be unsustainable when the furlough scheme comes off. So lenders should now be preparing for 12 to 18 months. What are my customers going to look like? How are we going to continue to lend this huge tranche of money that we've all got, as Nick alluded to? The liquidity in the market is crazy. So start preparing for the market that's going to need to be served in 6 to 12 months time, and start to innovate, test your products, use companies that you're comfortable working with, that can sort of trial a product for you and then have it ready for when the market needs it. I don't want to be the doom monger, but we've all been talking about things like holiday let sectors and what have you, and it's a real boom in the staycation. One of my concerns actually is, do you end up with a flood to the market? Do you get to this stage that we had in 2007 and 2008, where we had new build flats going up in central city locations, and we had investors buying 10, 15 in a block, and then suddenly they're all on the market for rent? Do we get to a situation where some of these lovely holiday locations are just holiday lets because people have put all their money in it? And then if the demand does shift, if, as Miranda said, people start jumping on planes again, you've got people that maybe have jumped on the bandwagon, are not seasoned investors, are left with these properties which are typically on higher rates of interest, and if they're not keeping them occupied, that's they've got a debt to service there. So there's definitely some real opportunity in the market. There's also some areas that we're certainly making sure that we're giving clients some cautious advice about whether it's the right thing for them to do or not.
Can I jump in now? Paul, I think you've made an amazing point. It's something that I've been saying for the last year, is that as soon as furlough finishes, I think that's going to have a domino effect on absolutely everything. Because if you look at a lot of these businesses that have got people on furlough to help them, great, I think it's a great thing. But companies now have realised that they can consolidate their business, they can work with much lower overheads and have higher margins. That all that's going to happen as soon as furlough finishes, a lot of these businesses are going to convert these people on furloughed into redundancies. You're then going to have unemployment go through the roof, and that will naturally then have a domino effect on the housing market. I personally think that we're in a bit of a false bubble at the moment, simply on the basis that if you look at everything that's happened globally in the last 18 months, there's no way that prices and demand should be as high as what they are. It's only because you're having the CBILS, the furlough, all of that is helping people. It can't sustain it. It's absolutely impossible. Now, again, like Paul, I don't want to be doom and gloom, but I think we really, really need to start preparing for what the market is going to look like afterwards. I think I mean, we have quite a number of substantial property investors and developers that we know at the moment they're not buying because they just can't get anything for the right price, and everything the land prices, for example, especially in London and the southeast, is through the roof. So they're all sitting on their hands waiting for this little bubble to burst, and then they're going to come in and start buying up at more competitive prices, because at the moment it's just not sustainable, the prices that people are demanding. I think there's something as an industry we need to really prepare for, because I personally think it's going to happen.
Yeah, sorry, Beth, just going back to your point about the clients we're seeing on the platform, the other end of the spectrum actually is we're seeing clients that are potentially a little bit more wealthy. They've not been spending their money on holidays to Barbados and what have you, so they built up a fund, and they're starting to look at the property market for the first time in some cases. So we've started to see a huge uptick in auction people coming to us that are looking for auction finance. I know that the auction houses, some of the auctions that our clients are going to, the properties are going just for ridiculous money, and I think what's happening is, as Nick said, some of the savvy investors are just stepping back and saying this is just overheated. So what's happening is your new investors with a bit of cash to play with are stepping into that market, and it's fueling this sort of overheating. Some of the properties that we see, the guide price, they're going for 3-4 times guide price, and when you look at the open market value on a renovation of it, the margin is so tight that you wonder, I don't know whether they're necessarily thinking it through. It's just, let's deploy my money. It's sat in the bank doing nothing. If I buy this, I might be able to make a quick 20 grand on it. And it's down to, I think, our community, our broker community, to make sure that we explain this process to customers that are doing it, particularly if it's the first time they're doing it as well.
We've got a responsibility to our lenders on that basis as well. Now, the problem that we've got is at the moment that we're starting to get to the stage now where I wouldn't say lenders are starting to lend on anything, but they're taking a lot more of a relaxed approach in certain areas, because they need to deploy money and get it out the door, because it's burning a hole in their pocket as well. But if you look at some of these, I mean, listen, historically, it always, on development especially, it always works on a third to purchase, a third to build, and a third is your profit. At the moment, you're looking at people that after finance costs, they're looking at 10-12% profit on cost. It's scary. And lenders, in my personal opinion, probably shouldn't be going and doing deals like that, because you have a slight downturn in the market, you have a cost overrun. All of a sudden, you've eroded every little bit of profit in that deal in the first place. And then have you got the motivation to then go and see it through? Have you got the capital behind you to go and stick more money into it? It's getting a little bit scary out there, if I'm being perfectly honest with you.
What about Nick? What about build costs only going in one direction?
Yeah.
They are. Build costs are going through the roof, and you're still getting people turning around and saying that they can build or do a new build scheme at £125 a foot. It's never going to happen in a million years. If you can go, I mean, in some instances, your timber and your steel, if you can get hold of it anyway, you're paying 30, 40, 50% more than what it was a year ago.
Yeah, I had
No,
a
but
chat with a builder this week, and he said steels have gone up 30% in 2 months.
you know, it's crazy.
Do you expect to see more lenders only lending or focusing their lending on more experienced investors as a result, like you say, the savvy investors that know kind of the cycle?
Yeah, that's always been the rough rule of thumb, that they look for experience. Okay, whether that is, I think what they're looking at now, though, if you haven't necessarily got the experience, but you've got a decent net worth behind you and you've got a good professional team coming in to support you on it, then they'll take a view, and so they should, because people need to start somewhere. And I think the SME housing market is really what fuels this country's housing growth. Okay, it's not just down to the regional and national house builders. The SME space is probably the space that builds more houses than anybody in the UK. So we have to support that. There's no doubt about it. It just has to be done in the right way.
Yeah, there's comparisons actually to the wholesale funding market. If you think about it, you know, if you go out and create a bridging lender, you're going to get your first tranche of money. You're going to pay a lot for it because you've got no experience to borrow that money. And you need to focus on a simple asset class to prove concept. So you take residential property, standard bridging, you lend 5, 10, 15 million, you've proved concept, you then go back and you can get cheaper money and you can start to diversify into more complex areas. It's no different to a developer, really. If you're a first-time developer, you don't go in and buy a hotel and convert it into flats and, you know, 150 units. You start with something that's fairly simple. You prove concept, you learn your mistakes on a smaller scale, and then as you grow, you get access to cheaper capital. It allows you to look at bigger opportunities and more complex opportunities because you've got money and experience behind you. So I think that's, as Nick said, it's a sensible way to do it, is to look at the experience, but also look at the team that you build around you.
A couple of you mentioned earlier, you know, about the stamp duty holiday and how it's kind of fueling this false economy in the property market and its kind of ramifications in the long term. Tanya, with the first phase of this holiday coming to an end tomorrow, how will this change demand for specialist finance, in your opinion?
I think there is going to be a tapering off. That there has to be, based on all the levels of lending that everybody is doing and inquiry levels for June. Of course, we're still in a little bit 3 more months of stamp duty deadline, even though it's tapered. So there still will be, you know, demand at a certain level. But I think that we're still going to see a fair demand before we see the drop off that, for example, Nick and Chris and Paula have spoken of. I think we're still going to be 3 months into that bubble. I think some things are likely to remain relatively calm. With regards to unregulated bridging, like Paul mentioned, auction finance has always been popular. There's always that speed element, that certainty of purchase, that potential to get a bargain that interests us in this country. So auctions, you know, will continue to be something that people want to invest in. I think we'll still have motivated vendors because the lifestyle changes that we've all noted, that's not going to just stop at the end of stamp duty or stop at a certain date. That what we've seen in the last year is people making a quick decision to change their lifestyle. But I think in the next 12 months, you're going to see people that are more considered. But still, the impacts of the pandemic, even if it hasn't affected your pocket, if you've been lucky and it hasn't affected your pocket, it still has the opportunity to affect the way that you think and the way that you want to live and the way you want to move and how you want to invest. So the ramifications of that, we're not even halfway through where we need to be on that. I think competition in the market, a couple of you have said that there's quite a lot of lenders. I think that sort of drives pricing in one direction, and then that may lead to, you know, more demand for bridging finance. But I think the bridging market as a whole is a fair size. It's 4.5. It's reported to be about 4.5 billion. It's probably a little bit bigger than that. I think what we will see different is the reason for loans. So typically with a bridge loan, the main reason in the past has been refurb or just investment or business borrowing. And I think in the last certainly 6 months, what we've seen is the biggest reason has been for chain breaks. So that certainly is going to go back to where it was before, with the main purpose being refurb, to be able to get more from your property. So that might be landlords doing extensions or extending the size of what they're doing, or changing the model from buy-to-let to HMO, things of that nature. But I think the demand will certainly calm down, but I think it will take a while to drop off. But again, it's such a difficult thing to surmise. This is not a situation any of us have been in before. I think what Nick's saying has got to be right. It can't sustain at this level. I think what we will see is whether we drop off a cliff or whether we gradually move back to something a little bit more sustainable.
Miranda, what do you expect in terms of inquiries post tomorrow evening?
I think there will be a natural drop-off, but I think so much is reliant on so many other factors. And, you know, I think inflation, it seems to be growing at quite a frightening pace at the moment. It's interesting. I find lenders in the regulated market, you know, you have calculations done on affordability, but as soon as you bring inflation into place, that sort of never seems to change on what people can actually afford. I think that's going to be huge. I think it was 2% roughly. It's just been reported as. I think what the government does with regards to industries and SMEs and any stimulus that they bring in is going to have a massive issue. So if we've got furlough dropping off, but at the same time we end up in a situation where there's maybe help for a longer period of time on business rates, and they've just been hiked up this year, which seems slightly counterintuitive. And more help with regards to the government stimulus, you know, potentially you're not going to feel a drop in the housing market. So I think it's going to be overall customer and consumer confidence, employment rates as always, and the cost of living, which right now feels quite expensive.
The next thing I'd like to discuss is the obviously the recent delay with the lockdown easing. It looks like it's set to go ahead on the 19th, I think it is, as of the news that came out yesterday. But Lorenzo, have you seen kind of attitudes from Together's point of view towards lending change as a result of that delay? And also, what has the borrowing appetite been like because of that? Let me just check your audio quickly for you. If anyone wants to give an answer while we're waiting for Lorenzo.
Yeah, absolutely. I'll jump in while you help Lorenzo. I think there has.
I mean.
Oh, you're in. Okay, good. Well rescued, Lorenzo. we went 8 minutes without a technical hitch, so that was good.
No problem at all. I think there's going to be a degree of attitudes and changes in regards to our lending and risk. I think Nick and Paul sort of mentioned this earlier. I mean, as we're coming out of this lockdown, you're seeing people coming off furlough, CBILS, you know, government loans. There's going to be more unemployment. It's clear to see. We are living in a bubble. And as I mentioned before, you know, if you couple all of those things, we've got to look at it from a lending perspective and consider those transactions on a case-by-case basis. So, yeah, in that perspective, we will be looking at things a lot differently going forward.
Okay, great. Nick, would you add anything to that in terms of borrowers' attitudes changing because of the lockdown?
Yeah, listen, I think you get two different types of borrowers that will be looking to come into the market. You've got I think Paul that mentioned new investors coming into the market. I think you've got all the experienced guys, I think, are sitting on their hands looking for the right opportunity. I mean, people are turning around and saying that offices is going to be a is going to be an area that is going to be affected most. But I think if you start looking at the serviced office model in commuter towns, where you can have a base closer to where you live, where you've got a link into London if you have to come in for a meeting, that's a model that we're seeing is starting to take off quite a bit. I mean, near where I live, we've got about 3 office buildings that are going up 100,000 square foot that are going to house 400 or 500 people in there. You know, and these are people that work from home but just want to have a base locally where they can go and have their meetings. It's opposite a station. If they need to fly into town, they can do. So I think with all the doom and gloom that we're talking about, it's always going to create opportunity in one way or another. So what might be to the detriment of one asset class, well, there'll be opportunity to the other. I can see the high street going back to being a residential led high street. I think a lot of these commercial spaces, I think that the sad thing is a lot of them won't be able to recover from it. Okay, and as much as we've seen help from the government and they have been fantastic, a lot of these injections into people's businesses has probably, if it's say I don't know, a sole trader has got a little coffee shop, not a coffee shop, it's a bad example because they've been open, but any type of retail shop, they may struggle and may not be able to come back from it. And that help has been not to keep the business alive, but probably to keep their own personal life going as well. So can they recover from it? I'm not so sure. Listen, it will drive. There will always be opportunity one way or another. At this present moment in time, though, I won't put my hand on anything and say I can tell you exactly what it is. I think we've just got time will tell. See where it goes.
You make a good point there, and you know the support that the government's given to some of these businesses that might not exist in a year's time or even sooner. It might just be prolonging the inevitable.
Inevitable, correct.
Yeah. Tanya, I think you mentioned a bit earlier about chain breaks being the most common loan purpose for bridging loans, and that's kind of changed as a result of COVID. And I'm going to make this correlation that there might be more advisors now in the specialist finance space because the high street aren't really I guess adapting to the changing borrower needs. They're looking to the specialist market. What are the upsides and downsides of more advisors encountering a greater number of diverse and specialist cases that they may have not dealt with before?
Thank you, Beth. Yeah, I think the upside is, of course, that advisors can broaden their knowledge, their expertise to the types of complex scenarios that are out there. I think that if you're an advisor that's not been exposed to a specialist or complex scenarios, there's lots of support that you can get from master brokers and sourcing systems and packages and things of that nature. But I think the upside of having those complex scenarios, certainly for the client, is that there are lots of solutions out there that advisors need to be able to access. And so the more that they get to understand lenders and what they do and ask the right questions, and the better they'll be equipped to actually serve their clients and give them a good sort of customer outcome, really. I think the downside is that if you are an advisor that has not been exposed to specialist or complex or diverse type of scenarios, then you might find yourself in a place where you're not sure where to go. But again, there is lots of support out there for all types of advisors. Like I mentioned, there's so many sourcing systems and master brokers, absolute experts in this field, that specialist lending is their BAU, is their everyday cup of tea. So that's where you should be leaning on those packages and those master brokers to sort of give you the steer that you need. Of course, speaking to lenders, we're always open to answering questions and helping advisors on where they need to go. And a lot of advisors are surprised that there is such bespoke solutions for such complicated scenarios. So I think the upside on this is that the specialist market is sort of not coming up more because it always is there. It always is there as a gap to what the high street can't sort of deliver or is underserved. But I think certainly for advisors, opening their mind and knowledge to specialist lenders is a good place for them to be at the moment.
Also, over the past year, we've seen some lenders and surveyors and solicitors struggle to cope with the influx of applications, which has created a bit of a bottleneck. Hopefully that will start to subside as the stamp duty holiday comes to an end. But with speed and service vital in the specialist finance market, particularly bridging, how are brokers able to navigate who will or won't move the goalpost, especially those advisors who are new to the market? This is a question to anyone on the panel.
Well, I would say that it's relationships and partnerships between brokers and lenders. And if you know your lender and if you have that relationship, you can have the trust. Often that trust is built with experience. So a lender like ours that's been around for 46-7 years, that experience is always there. So it is a little bit more different for new entrants, obviously. But I think it's that relationship piece. And the word partnership is quite important, because you have to work with brokers like they are your partners. It's about an exchange of information. I think as long as that relationship is there, then that trust piece should be there. And if information is shared accurately, so what I mean by accurately, there's a responsibility on the broker to provide as much information up front as possible. There's a responsibility on the lender to ask the right questions and to assess as quick as possible. I think if both parties are doing that, then there shouldn't be any movement of any goalposts in that respect. I think solicitors play a big part in this as well. Obviously, funding cases as quick as possible is the key for all of this. And again, that's about being open with communication. At Together, we do something called an internal funding, where a certain proportion of our cases, the ones that we deem to be non-complex, like something under 200,000, that doesn't actually need a solicitor to complete. So that helps in the speed of acquisitions. But I think in general, knowing the lender's process, knowing the technology that they use, trusting the technology, knowing that they're being as efficient as they can, all of those things help with brokers, solicitors, knowing exactly where the goalposts lie. There should be no movement of goalposts as long as everybody's upfront and can trust each other and be honest, really.
Yeah, the relationship piece is something that's really, really important from our, as a business anyway. I mean, do we have access to the whole market? Absolutely. Do we use the whole market? Absolutely not. And I think you've got your new entrants that come into the market that have got a good offering, and they're doing stuff that maybe some of the other lenders aren't doing. But it comes down to the trust, and it takes a while to build that trust with a new lender coming into the market. And it's one of them where if you've had a history of a lender delivering for you, that's always going to be your first port of call on every deal. So that for me is worth its weight in gold, probably more than pricing, because I think ultimately this whole thing with the rates, the way they're going, and it seems to be a race to the bottom again, it's something else that isn't sustainable. And you can, the rate, yes, the rate is important. Is it the most important thing in the world that we live in? Absolutely not. I think deliverability is much more of an important factor.
Yeah, and the relationship's so crucial. Yeah, that if you've got an important deal, you're not going to try a new lender. You're going to go to that person you've got that relationship with. You know they can perform. You know which valuers they're going to use. You know their legal process, their underwriting process. You know they can deliver. So yeah, there's new lenders are great, and if they've got a little niche where they perform better than another lender, which might make that deal happen, where without them it wouldn't, then great. But if that deal's more standard, then the relationship that you've built up with the lenders over the last few years is going to be absolutely critical.
Yeah, I would echo exactly what Chris and Nick and Tanya have said. And actually, something that we're working on here is to trying to build. We've called it Propp Score, but we're trying to convey that message to some of our customers that are starting to use the platform. We're still in the process of sort of understanding how to present it, but it shows that clients can have a look at the pricing, but we also need to they need to understand what flexibility does that lender give. how are they with speed? All the areas that you need to understand when you're doing a bridging loan or commercial, so that they're not just looking at the lender that turn up at the top of the table. They're able to see what they get for their money as well, and then make a conscious decision. If you're an experienced investor, if there's 2 bips in the deal, but this lender have got a 5-star rating for speed, for example, you're more likely to look at that if you need to get a deal over the line. As you said, you're looking at margins, you're not looking at cost when you're an investor quite often.
I really like that point, and it's the reason why we have never used sourcing systems for our lending and for our clients, because I think most sourcing systems are going to go just on rate and loan to value and things like that. They don't take in our world, in the specialist lending world, you can't go just off of a rate card. There are so many complexities and so many anomalies to every single deal. It makes absolutely sense it makes no sense to go and use a sourcing system. It comes down to product knowledge. If somebody was to go and bring in something like that, where there is some kind of algorithm to facilitate the speed and the complexities and the deliverability of a lender, that's a game changer. So I think that's a really, really valid point.
Yeah, what we found is it's a lot harder to do than we thought it was going to be.
I can imagine because there are so many moving parts to it. I get it. I personally am not sure how it could be done. If you can find a way of doing it, I think it's a game changer.
We'll keep you posted.
Keep us posted.
I'm just going to ask one question that we got from the audience, just because I know we've just gone over 12, so we need to wrap this up. But the question from the audience is whether or not the panel has seen a rise in regulated bridging as a result of more advisors entering the specialist finance sector, as high streets aren't keeping up with the changing needs of borrowers. Does anyone want to answer that question?
I would say I don't think we've seen an uptick in it because of more advisors entering the market. I think we've seen an uptick because of what's going on at the moment. Stamp duty, chain breaks. We've definitely seen an increase in inquiries. As we've already discussed, whether that will continue after tomorrow and September remains to be seen. But there's certainly been an increase in chain break and regulated stuff. Yeah.
Okay, brilliant. Thanks very much for that. So we are now at 2 minutes past 12, so I will need to kindly bring the event to a close. That was a fantastic discussion and some really good questions answered there. So thank you to Together for partnering with us on this, and thank you to our fantastic panel for taking time out of your very busy schedules to be here. And I also want to thank you, our audience, for joining us today. We will be publishing this roundtable in full next week on B&C for those that weren't able to make today's event. And if you enjoyed this one, you can check out our event calendar on B&C. We are holding them every week. And for more insights and news on the specialist finance sector, the latest issue of the Print Bridging Commercial magazine is out, so you can access that on our website too. But have a fantastic afternoon, and we hope to see more of you in person soon. Thank you very much.